this. So is there any questions in regards to last week's session? Is there anything anyone was confused about? Is there anything anyone wants to talk about? You can type it up in the chat, make it much easier for me to read out. Or if you want to unmute yourself and talk about it, feel free to do so. Okay. So does someone have anything to say? Someone just unmute it for a second.
Yes, sir. Good evening.
Good evening.
AUDJPY was highly volatile. When I entered on Monday, like you said, I was taking out and I was waiting for a pullback, but I missed a second entry. But it went toward the direction, but before it went, so it highly fluctuated a little bit before it went towards our presumed direction.
Okay. So if we look at AEDJPY, right? Let me see. So Monday was on the 14th. So if we go back to the 14th, right here. So when price opened, it went up a little bit. I'm guessing this is where you got kicked out, right here on this rate.
Yes. Yes.
Yeah. So what happened is if you had gotten your position somewhere around here, for example, and you didn't put a stop loss in place or lock the position into profit when price was moving up a little bit, you would have got kicked out. Now, in scenarios to avoid this type of chaos right here, because not everybody has a big account to hold when price pull against them. So what I normally recommend is you can go on the 15 minutes time frame, for example, and let me just go, let's look for the 14th. So this is a 14th. On the 15 minutes time frame, what you want to look for is this. You only want to trade when price cross over your 200, 20 and 50 EMAs. You understand? So if you have a very small account and you know that you can't really hold when price is pulling against you, then the best thing to do is wait for price to cross above all 3 EMAs, right? So that would give you much more security because they will act as dynamic support and resistance. Now, if price cross over this EMAs, how do you know specifically when to go in? That's when your entry indicator comes into play. Now, depending on how you trade, a lot of people, some people don't use indicators, some people do. In most cases, I don't, but some cases I do when I want to let my EA trade for me. And what I normally tell my EA to do, which is my robot, is wait for price to cross above the 20, 50, and 200 EMA. And then when I get a buy signal, like you see this buy signal, this box is right there, only then do I trade. So what would happen is if you follow that rule and you have like a entry indicator, you would probably not get an entry to somewhere around here. So in my situation, for example, this indicator that I'm showing you that just gives me entry, I got a buy entry right here, but price was just above the 20, but below 50 and 200. Another buy entry came, price was still below the 200. Then another buy came, price was below the 200. So you don't move, price was below the 200. But this buy came in and price was above the 200. And guess what happened after that? If you had went in at that point, you would have properly profited from the trade till this point. You know, so what I recommend is if you have a very small account and you want to trade the asset, what you should do is follow specific rules, which is the 200, the 50, and the 20. Price has to be above all 3 if you're trading up. Price has to be below all 3 if you're trading down. And then when price is there, you look for an entry indicator that points in your direction. I prefer the PZ, that day trading indicator. It's quite good for me and I use it for my robot. So what I would recommend you do is wait for that. So that way you would get a much safer trade. But what would happen is you're going to miss out on a major chunk of the trade. You know, I mean, we missed out on 92 pips right here if you're waiting on that. But ultimately, even though you missed out on 92 pips, you were playing it safe and you still profited about 64. Let me see if I can draw a line right. It's going to be 2. Let me change the color. So let's see if we can find something here, something that stands out. So if we go on a 4-hour time frame, for example, what we're going to look at is web position. Let me go on daily actually. So if you had gone in somewhere around here, right here, you would only have profited about maybe 50 50 pips, 60 pips, you would have lost more, in the long run, but at least you will be safe, So that's the thing for people with smaller account. You'll be safe, but your profit might be slightly lesser than other people's profit. You understand? So that's what I recommend. Alternatively, you can see on the daily time frame, price came down and touched the 200. You could have gone on 200, but you need a stop loss you need a very wide stop loss, which is your ATR value. So the safest option for you is wait for the 200, 20, and 50 price should be above it or below it, then get your entry indicator. Once your entry indicator gives you a sign, then put your stop loss below where your entry indicator gives you a sign. I hope that clarifies that part. Yeah. Okay.
Yes. I'm clarified. That is normally the way I take my entries. I've mastered how to use the moving averages. That's the way I take my entries. But
Okay.
what I observed, it was volatile last week. So, but I saw a second entry, but it was late, so I decided not to enter because it's not risky.
Okay. In that situation, that seems to be a very wise choice. When you see a second entry, for example, or an entry, and it looks like it's already too risky, just let it go. There's always going to be positions in the market. The market isn't running, so the best thing is it's better you should be safe than sorry when it comes to trading. Okay.
One more thing, I would like to know your name so that I can address you by that, because I'm sorry you don't like someone addressing you as sir.
Yeah, I don't like people addressing me as sir. My name is Deji, by the way. I'm Deji. I just don't, funny enough, I don't really mention my name too much to people. I like to keep myself low key. So, yeah, so does anybody else have any questions in regards to last week's trade? Any questions at all? Okay, in that regard, what we're gonna do is, if there's no questions, let's move on to today's one. Now, there might be people that are new here today and might not understand our trade, so I'm just gonna go through the drill. The people that have been with me, bear with me. I know you guys have seen this so many times, 3 years, 4 years. Some of you have seen this. So, but we gotta walk the people that are new through this. Okay. You guys can see my screen, right? Can you just see my screen? Just indicate you can see my screen. Okay, thank you. All right. So the first thing I want to look into is, for the guys that are new, we have 3 tools. There's one called the COT. There's one called the seasonality. There's one called probability. And there's actually one called spread. I just call it spread anyway. Now, these 4 tools that I said 3, but there's 4. These 3 are online. This one is an indicator. So these 3 tools help you shows you what the market is going to do. So I'm going to try to cram everything in a very, very short time because we only have about 25 minutes left. So COT shows you what the banking guys are doing. So banking and commercial guys. That shows you what the banking and commercial guys are doing. The second one is seasonality tool. And this is something that happens every time. Every single thing in this world has a season and everything has a cycle. So prices go up when it's a Ramadan period for people that are Muslim. Prices of cattle and goats and all of that stuff goes up. And prices of chicken and turkey goes up when it's Christmas season. And after that period, it drops. So one thing is, if you understand the cycle of something, then you can piggyback up of that move. I mean, for example, now if they trade cattle, people do trade cattle. What you can do is every Ramadan period, you can always make money during that period because you just put your money in cattle and the price of cattle will go up. So that's what the seasonality tool does. So it deals with cycles, and the third one is probability, and this is literally just percentages of win. So percentages of buy and sell. So I'm not really going to describe this tool because literally this is company secret. I can't really talk about that one. But spread, Williams spread is something different. It shows us what's going to happen before it happens. So it correlates the market with gold, and then it's been pretty accurate in most of the time. In most of the years and depicting the market if it's where it's going to go before it goes there. So It literally shows what happens before it happens. So those are the 4 tools. Now I'm going to show it to you, and a lot of you might be very confused. So bear with me. If you're confused, it's something that takes a while to learn. This is stuff that's been in the making for years. So I'm going to try to cram it into a very short period of time. Yes, we're going to do gold in a second. Yeah, all right. Okay, so the COT report, basically what we do is we look at what the commercials, what the big boys are doing, right? People, majority of the people that trade the market and trade assets, for example, most of them are retail traders. Then they're the big boys that trade they trade a big move. They have the, they have the funding, they have the backing to trade the market. So they have internal information from the government on what's going to happen before it happens. So they're categorized in different categories. So the first one is the commercials, right? And then commercials are the big boys. Some hedge funds are there, some big banks are there, companies like Apple, mining companies and all of that stuff. They're underneath this bracket of commercials. Non-commercials are people like you and I, retail traders. A little bit of some small banks are there, some hedge funds are there, non-reportable people that have a lot of money that don't want to be mentioned. Okay, so now what we normally do is we follow these guys because these guys are internal information, the commercial guys, right? Because they show us what's going to happen before it happens, because they need, they need this information to make money, not from the market, but for their goods and services. If they want to buy something in China, for example, I want to be sure of what's the price of, dollars to whatever currency yen that they're spending there, right? And if I want to buy something in, let's say Ghana, for example, I want to know the price of the currency before time. So I want to go in exactly when it's going to favor me. So that's what they do. They use to buy stuff, physical stuff. They're not using it to trade. They're not trading off the margin or what's happening, the fluctuation of the market, buy and sell. So what we tend to do is we focus on these guys. These guys, non-commercials, are people like you and I. Most of the people here are wrong. They're pure blank wrong. 95% of the people that that trades, most of them lose money. A lot of them are doing fugazi stuff, right? But most of the people that trade lose money. It's just facts. So if you join a broker, they always tell you, disclaimer, 76% of people lose their stuff, 86% and all that stuff. This is where the category of most people fall under, right? The brokers and everybody at whole here. So we want to trade with the big boys. And what we're seeing now is we look at their changes, right? The changes over time. So over a period of a week. So this report came in on the 15th. So on the 15th of February, and this report always comes in once every week. So we always have a week lag. And with the week lag, it's beautiful. It still works perfectly. So on the 15th, on the 15th, what we see is these guys, commercial people that we want to focus on, ignore these guys, non-commercial, we don't care about them, and ignore this guys, non-reportable, ignore the total, focus here. So these commercial guys, as of the 15th, they started selling 27,000 new positions. And some of them are buying, 509 positions. While these other guys are buying. Now, for the guys that are new, long means to buy, short means to sell. That's what it means. Long is buy, short is sell, right? That's all you need to know. So at this point, these guys are selling. Why would they have 27,000 new position going short? That's a big question. Why would they do that? And why would these guys add so much position going long? So if I ask you this question, if you're the head of Apple, for example, if you have a friend, right, and your friend is the head of Apple, and you have a second friend, is just a normal trader, who would you follow when they tell you, you know what, I'm trying to sell or buy a share? Can you just leave it in the comment section? Who would you follow? The Apple CEO or your friend that tells you buy or sell? Please let me know in the comment. See if everybody's following up. Okay, Apple CEO.
No.
Okay, beautiful. So thank you. What you want to do is follow the people that have information, because the Apple CEO is more informed than your normal friend or your normal broker. Your broker is not your friend. Your broker, they lose money when you make money, basically. So you don't follow any of those guys. You follow these big guys right here. Now, if these guys are selling, it's telling me that I should anticipate that the price of gold is most likely going to go down, right? So what I'm going to do is, let me try to get a clean chart. Beautiful. So the price of gold is most likely going to go down. And if you trade price action, for example, you see price has been tanking for a while, you know, what would you do? You've seen that there's one point that this price is actually going to pull back down. So these guys are already giving us an indication of when price is literally going to pull back down, but we do not know when, right? We don't know when the price is going to pull back down. So the next thing we do is we go to something called seasonality. Remember I said at specific season, the price of turkey goes up, the price of cattle goes up, at specific season, it goes down. So we look at a seasonality chart, and this seasonality chart has been compiled over several years, right? It shows us the price of, gold from the past. Let me see, we have 47 years of data. So 47, 15 years, and the past 5 years. So what we've noticed is at specific period in time in past 47 years, 15 years, and 5 years, price correlates. So as you can see, price can start to go up from around December, and then will start to drop from around February. Now today's 20th, right? And if you look at here, for example, 23rd, price is about to drop. And if you look at around here, look at price from around here, 16th, for example, and what you can see is price has been going up. See the 16th? On the 16th, bang on 16th, price started going up. 440 pips. And this already shows us that's going to happen from the 16th around here, right? You can see that. So now what we can see in the seasonality is from the 23rd, price is meant to fall, right? So 23rd, price is meant to fall. Now, I'm just going to go and jot down something right here. So COT for gold, let me actually put it like this. COT gold, we have that going short. Seasonality gold, we have that short. And when is it going? 23rd. Now, keep in mind something. First strategy told us we're going to go short, but it never told us the date we're going to go short, right? We know the price is going down, it's going to sell, but we don't know the date. The second tool shows us the exact date that we're going short. Now, sometimes those dates fall on a Saturday, on a Sunday, right? So you don't trade on those 2 days. Now we have the third tool, which is called probability. And this also shows us a percentage that we have to win on a specific date. A lot of guys love this tool. I'm not going to lie, this one, a lot of people love this tool because they believe this is work. People believe looking at the commercial COT report and seasonality is work. So a lot of people just sit down here and want to just trade with the probability. But I don't encourage trading with the probability because, as you can see, some days you have 60% chance of a win. To some people, it's okay, but I'll rather stack up the move in my favor to have about 80–90% chance of a win if I'm going to trade a market. Okay, so let's go to the date, 23rd, right? So what we're going to look at here in 23rd is this. Look, from the 21st of February, price is telling me I have a 52% chance if I sold tomorrow. The likelihood of me getting a sell tomorrow, a sell candle tomorrow, is 52% chance, right? The next day after that, I have a 51% chance of getting a buy candle. But on the 23rd, I have a 60% chance of getting a sell candle, right? Now, ideally, what I prefer to do is when I see my COT report and my seasonality aligned in specific direction, I want my probability. So I want that to give me 3 days. So 3 days going in the same direction, right? Now, on the 23rd, I only have 1 day giving me down 60% chance of a sell. As you can see, it's higher than the previous 2 days. So most likely on that Wednesday, gold is going to fall. Now, because I like to see 3 days makes it much more safe for me when I trade the market because that gives me a low risk trade. There's 3 categories, actually 4. Super high risk trade, in which let's just say COT report aligns and seasonality does not align, or seasonality aligns and COT does not align. Then we have the high risk trade, in which 2 of them align but probability does not align, right? And then we have the medium risk trade in which all three aligns together, but the William doesn't align. So the William is this tool. Let me find that tool for you. I think, okay, let me try to look for Williams. All right, here. All right. So Williams basically shows me what's going to happen before it happens, like that. So it shows me prices most likely is going to start going up, and not long after price started going up, price is going to go down, price started going down a little bit, you know, and price is going to start going down at a point, and then price started going out at that point, but you have to catch it. So we use this to look at the overall outlook of the market. So let me pull gold back, and I'm going to delete this. So currently right now with the gold trade, because we have seasonality going in our direction, we have COT going in our direction, but probability does not give us the 3 days that we want. So this automatically falls under the category of high risk trade, right? But because you know price action and you know how to maneuver the market, you can turn this high risk trade to a medium risk trade, right? So we know on the 23rd, we have a 60% chance of a sell. Then 24th, most likely price is going to pull back. It's just a slight escape, 51% back up. And then we have a 61% chance sell. Then we have the weekend, and then we have a buy again. So it's kind of consolidation move that it's showing me that's going to happen. You understand? Before March, that gives me 3 days straight down, March the 1st, right? So if I go back here, March the 1st gives me a 3 down straight move, but look, my seasonality does not align anymore. So because we've spent so much time looking at this asset, and we probably have 11 minutes left in this webinar, what we're going to do is this. For this trade, gold trade, we're going to sell gold trade. Now, remember, this is a high risk trade because probability does not give us, you know, what's it called? 3 days. So we're going to sell gold high risk, and we're selling on the 23rd. Right, we sell on the 23rd, and we're going to exit on the 2nd. Exit 2nd, right? That's our exit, 2nd of March, right? So what we expect to happen in this market is this. We expect gold to start dropping on Wednesday. Now, for the guys that have a small account, remember the rule. You can go on the 15 minutes time frame on that Wednesday and wait till price comes below the 200 EMA, right? If price comes below the 200 EMA, then you can load whatever entry indicator that you want. And when you get that sell, guess what you do? You sell, okay? So all you're waiting for is the sell signal on Wednesday when price is below the 200 EMA. Does that go clear enough? Because I've noticed most of the people that signed up, most of them have a small account. So most of you, this rule is applicable, right? And because this trade is kind of a long-term trade, it's not too long, I think about a week plus trade. What you can expect is if we get an entry, let's even say somewhere around here, you can profit about 300 pips, 361 pips, or up to 400 pips. Now with 400 pips on 0.10, that's $400. You know, and it would what's it called, 400 pips on one lot, that's $4,000. But some of you won't be able to trade with that because if your account is less than 100, you can't trade with more than 0.01, right? But with 400 pips on 0.01, you're going to make $40 if you use 0.01. With 400 pips on 0.02, you're going to make $80. 0.05, you're going to make at least $200. So what we do is you wait on that Wednesday when price crosses below the EMA. Make sure price crosses below the 20, 50, and 200 EMA. Then you use your entry indicator to look for an entry to go sell, okay? So is there any questions in regards to that? Does anyone have any questions in regards to that? Keep in mind, this is high risk trade. I'm making you guys trade high risk trade. Normally, I wouldn't, but because we don't have time to analyze more assets, that's why I'm putting the high risk trade forward. So is there any questions in regards to that? So someone wants me to check NASDAQ and GBP USD. Okay, if we have a little bit of time, we'll go through NASDAQ and GBP/USD. Okay, so I presume that's clear, right? So if that's clear, then I see no reason why anyone should lose any money this week coming. So if you stay patient enough and you wait, you would get a good entry and you sell. Now, there's one thing I want to point out. A lot of you might not know where to set your stop loss, right? There's something called ATR, average true range. And average true range tells you the average of the candle in the past, whichever period you set it to. So in this case, 14 period, in the past 14 days, 14 trading days. And the way I like to use this is I normally like to load it on daily or 4 hours. And what I do is I look at the numbers, right? So in this scenario, for example, market is telling me that prices moving the average of the past 14 days, 94 pips. Ignore this 964 at the back, just 94 pips. Now, the way I use this ATR is I always do ATR times 1.5. ATR times 1.5 is basically 90, it should be 94, 94 times 1.5. And if I'm not mistaken, 94 times 1.5 should give me 141, I think. Yeah, 141. So that should give me about 141 pips. Now, a lot of you guys don't have 141 pips to set as a stop loss, right? So if you happen to use your 15-minute candle for your entry and you're going down, for example, and you're selling when prices cross below that, all you need to do is put your stop loss behind the moving average, just a little bit behind the moving average. So for example, if this 200 has moved somewhere closely up at that time and price crossed below it, once you get that sell entry, you put your entry below, above, let's say here. So price will definitely have a higher low at that point. What you do is put your lower high, my bad. What you do is put your stop loss behind the lower high, and then you can trade that. Hopefully that's not up to 141 pips. Because you're trading gold, you don't want to be stingy. You don't want to put 5 or 10 pips stop loss. You might have to put maybe a little bit in there, maybe 50 pips stop loss. With a 50 pips stop loss and you're about to collect 400 pips, the risk to reward ratio is 1:8, right? So about 800% return on investment. So it's still beautiful to trade. So that's what I recommend for this trade. Now for your take profit, this is how you split your take profit. You go on your 4-hour time frame, you look at your ATR ratio, and you will have 3 entries, right? So we know that this is 94 pips. So the first thing is from your entry point, your first take profit will be 94 pips. So TP1 equals to ATR, let's say 4 hours, right? TP2 would equals ATR times 1.5. Times 1.5. So ATR times 1.5 in this scenario, for example, would give you 141 pips. So in the first one, your TP1 will be 94 pips, right? Your second one would be 141 pips, right? And your third take profit for 3 entries, you let that run till, I think we're exiting on the third, or second. So your third take profit will be exited on 2nd of March. 2nd of March, yeah, this year. So that way I've given you your stop loss, I've given you your take profit, and I've also given you entry, and I've given you directions. Does anyone have any questions in regards to all 4? I've given you the direction to go, which is sell. I've given you your stop loss to set. I've given you your take profit 1, take profit 2, take profit 3, and I've told you exactly how to go into the market with price action. Any questions? Now, if you're new, I know you're not used to this, and this might be a lot of information.
Hello.
To yes.
Yeah, good evening.
Good evening.
Please, yeah, is this being recorded? Because I would love to, watch it time and time over again. Please.
Yes. I would post the recording on Telegram. So it's going to be on YouTube, then I'll post it on Telegram. Okay. Beautiful. So
All right, thank you.
you're welcome. So basically that's what we need to do. If you're new, I know you guys are not used to this. You're used to seeing Fibonacci, trend lines, and all of that stuff. But most of the groups that you've been in, you're probably seeing the same tools over and over again. And you might be wondering, why is it that, my trading isn't working right? I'm doing what these guys are showing me and all of that, but it doesn't seem to add up. It's because of those guys don't really know what's going on. Most of them don't even know COT exists. If you ask most of them what COT, they're probably going to tell you, I know what it is. I know what it is. Then tell them to explain it to you. They have absolutely zero clue, right? Most of them don't even know what seasonality is. And most of them, I assure you, 100% of them don't even know what probability is. So what I'm going to recommend to you guys is do not follow the crowd. Wherever there's crowd, there's trouble. So most of the crowd are misinformed, So the thing is, you have to understand how the dynamics of this game works and play it professionally, right? So this level of knowledge that I've posted to you guys, and I'm showing you guys, it's a level of knowledge that most people within the firm have access to. But a lot of people in the retail world don't have access to this. So that being said, I don't want to prolong this. Is there any questions in regards to what I've shown you? I'm going to definitely post a replay so you can, you can see that and watch it all over again, right? And if you have, okay. Yeah, I know it's very new to you. I know. Just take a little bit of time. You understand. You come to the webinar more frequently. You understand how it works, and stay on the Telegram group. You see the results. So, and also watch the replays that will be posted on YouTube. There's quite a lot of replays on YouTube. I think over 40 videos on YouTube that I've posted. So you can always watch that, or you can actually get the access to the entire tool from the website directly, which I will post on Telegram group. Mr. Uzo, I know you did ask for GBP USD and NASDAQ. We won't have enough time to check those two assets because I really want to make this very simple for a lot of people to understand. If I go very quickly, a lot of people won't understand what I'm trying to put across. So for the new people that are here, so I try to go slow. We'll probably look at that when we have a session on Telegram and the talking session on Telegram, and I can then reanalyze that and then go into that. Okay. All right. Yeah. Oh yeah, that's true, Mr. Innova. Yeah, Clubhouse. No, not Clubhouse. I'm using the Telegram one now. Clubhouse seems to be just long. Trying to transfer people to Clubhouse is long, so we'll just do it on Telegram and we talk there. I figured that Telegram also has the same feature. Yes, the indicators are not repaid. These are not repainted indicators. As you can see, these already cover the entire year. Seasonality covers the entire year. Probability, this probability, I have probability up until December. So these are literally not repainted. There's no repainting here. And for some reason, there's certain days in the market you trade 100%, that you always win 100%. So if you want to have access to the tool, just go to the website. The website is, if I'm not mistaken, business.dmempire.co.uk, and I will post it on a Telegram group so you guys can have access to it. And depending on the region of the world, you have different access to the tool, so you can always select which one is best for you, so you can actually see more trades to take. So basically, what I'm just trying to show you is an alternative way to trade and have a stress-free trade, and this would benefit you in the long run if you take the time to learn it and study it. And you'll be moved away from the crowd of all the people there just drawing trend line and Fibonacci and all of that nonsense, out there, and you trade professionally. So on that note, that's it that I have for you guys today on webinar. That's literally everything I have to say to you guys. So I'm going to save this video and upload it on YouTube and, send you guys the link on Telegram, and we can take it from there. So if you want to grow your account, a small account, so far you have discipline, good money management, you can always use this tool to grow your account. and there's so much help that you're going to get from the internal videos and everything that's in there. Okay, so thank you so much, guys, for attending today's webinar. We will take it from the Telegram chat.
Hello, please.
Yeah.
One more thing. Sorry.
Okay.
Yeah, what are the colors of your indicators? Like 200, 50, and 20. What are the colors?
My primary colors, 200 is yellow or gold, 50 is red, 20 is blue. Those are the colors I use. Okay. So thank you so much for attending, guys. Mr. Uzo, hit me up on Telegram. We'll talk there. Okay. Take care of yourself, guys. Have a lovely trading week. All right. Bye.